think we'll just move into some of the types of products that you can look at, and I think if we just start off with that the IHT, or the inheritance tax side of things. And IHT, once upon a time, you would say, well, it's just for the wealthy, but actually, a lot of people, the home that they sit in is such a significant asset, especially when you go further down the country. It actually can bring them up to that band, even though they've got the property high IHT band. And Matt, from your point of view, when you discuss clients about their investments and you can see they've got a potential inheritance liability, what sort of tools are at your disposal to sort of mitigate and help clients to reduce that liability?
Well, there are many. I think actually, Jamie, somebody once said that it was for the wealthy and the stupid was inheritance tax. I think it was a bit disingenuous, but that was what in essence they were saying, that people who were incredibly wealthy had to pay some inheritance tax, but people who were not, so if they did nothing, would end up paying it inadvertently anyway. So inheritance tax has always proved to be a difficult one for anybody to address, because it's the length of time that you're going to live, and it's how much these are imponderables. You can't work out how long you're going to live or how much money you're going to need during that. So the best way, obviously, of getting an inheritance tax liability flattened is to give the money away, survive 7 years under the current rules anyway, and then it's no longer a problem for you. But the people you give it to, if they die, then it's a problem for them. So it's a really hard one to sort of chase throughout people's lifetimes. But if people are in a position where that's a real driver, that they don't want 40% of what they've worked for, what they've earned over the years, going to the government in addition to everything else that they've paid, then they've got to look at some kind of plan. And I think that I always say to clients, you get a plan, stick to the plan, be brave enough to stick to the plan. It ought to work out in the end. And looking at trusts as a means, if people are in a position where they can afford to use trusts, and again, trusts may be under the spotlight of the tax take going forward, to pay for the coronavirus. So that's another difficult one, because the rules have, in the last 15 or 20 years, when previously they didn't, they've started to change rules retrospectively. So that can be a little bit of a cause of concern. But primarily, if money is invested in some kind of trust that moves it from your estate, and the beneficiary class is who you would want to inherit your money, rather than the Rishi Sunak. I think it's probably a little bit more palatable, because everybody seems to like Rishi Sunak as our chancellor. To use other chancellors in the past, people would be thumping the table about giving it, thought it was good personally to that chancellor, but it's not. But I think Rishi seems to be distributing it in a manner that people are quite impressed by. But if they're wanting to keep it in the family or into their class of beneficiaries, and it combines with people wanting to plan for bloodline planning, with relationships, marriages breaking down. They're not wanting errant spouses to be going off with their money. So these trusts can cover two areas: one of sort of keeping it in the bloodline, as it were, and also keeping it away from the tax man, if they're used properly and if people understand them. And I think you need people to understand what they're giving up if they use trusts, but what they're achieving. They're a complex area, but they are certainly an area that we've used extensively over the years to enable people to control their money during their lifetime and when they've gone.
Yeah, great. I think the good thing for trust, you and I have had many a conversation about this, but the direction of money, as you say, they're really good products to look at that. And